Starting December 6th, the Nasdaq exchange will run continuous trading for 23 hours a day, 5 days a week. The official narrative from Wall Street is respectable enough. They are serving global investors, increasing liquidity, and reducing friction. But the true weight of this change lies behind a single strategic concept: pricing power. This move targets the very heart of how international risk is valued, ensuring that the benchmark for global assets remains firmly anchored in New York. To see why this 23-hour schedule is such a heavy defensive play, we have to look at the 3 pillars that have supported the American financial empire for the last 70 years. That empire began with the post-war financial order, a system built on 3 interconnected pillars that form a perfectly closed loop. The first pillar is the US dollar status as the global reserve currency. This diagram shows the baseline of international trade. Petroleum and central bank reserves are denominated and settled strictly in dollars. The second pillar involves the depth of the US market. Those global dollars flow into US Treasury bonds, which act as the foundational anchor for safe haven assets and provide low-cost financing for the American government. The final pillar is pricing power. Worldwide risk assets and tech companies are valued based on the price-to-earnings ratios of their US peers. This creates a loop where the Fed controls supply, treasuries absorb savings, and US stocks attract the world's risk capital. But in recent years, that loop has shown signs of loosening. Following the Russia-Ukraine conflict, the dollar was weaponized for sanctions, prompting nations to diversify. China, India, and Saudi Arabia have all begun exploring trade settlements in local currencies. This forces a single question for every major economy. If my US dollar assets are frozen tomorrow, what do I do? To prevent a mass exit, the US is now upgrading its market infrastructure. The first upgrade is a time dimension monopoly. By staying open nearly 24 hours a day, Nasdaq removes the physical barrier of time zones that once forced Asian and European investors to wait for the New York opening. Previously, these investors had to use local derivatives to hedge their positions. Now they can trade NVIDIA or Microsoft directly during their own daylight hours, routing global capital straight into the US system. This chart shows the mechanics of price discovery. The authoritative value of a stock is determined wherever trading is most continuous and liquidity is deepest, shown here by the heavy volume bars. When an American depositary receipt trades 23 hours a day on Nasdaq, its local share prices in London or Hong Kong are forced to follow this baseline. As liquidity aggregates in New York, other markets become mere shadow prices. Nasdaq's quotes become the unbypassable baseline for the entire world. When one market holds all the liquidity, it dictates the price for everyone else. Global crises, whether they are central bank policy shifts or geopolitical conflicts, never wait for a convenient time to strike. They frequently break out on weekends or unexpectedly in the very middle of the night in New York. In the past, when trouble hit while the US market was closed, investors could only flee to gold or the foreign exchange markets to protect their capital. By the time the stock market opened just hours later, the panic had often already completely boiled over. With a 23-hour Nasdaq, capital can react instantaneously. Whether it's selling off in a panic or rebalancing a portfolio, global investors can express their judgment through US equities at any hour of the day. This turns US stocks into a global sentiment engine that never stops running. It makes the world dependent on Nasdaq because no other market can provide an immediate quote at 3 a.m. when trouble breaks out in the Middle East. This 23-hour schedule systematically reinforces the closed loop of US hegemony. This funnel shows how the stock market entry point has expanded, accelerating the speed at which global risk capital circulates within the US system. By turning the US market into a perpetually open doorway, Nasdaq makes it incredibly easy for capital to enter and settle. The deeper that capital settles, the more difficult and costly it becomes to leave. This creates direct pressure on the Chinese market and Hong Kong. As US stocks push trading hours to the extreme, the competition for global capital becomes a contest of institutional efficiency. Investors naturally seek the market with the deepest liquidity and the fewest trading restrictions. When Nasdaq is always open, the security of being able to trade at any time becomes a massive competitive advantage. The battle for global capital today has moved into the realm of institutional infrastructure. In this winner-take-all environment, the efficiency and accessibility of the exchange itself determine where the money stays. competitors now face a choice. They must either accelerate their own reforms, extending trading hours and optimizing settlement rules, or risk a permanent drain on their liquidity. Another strategy is building core assets in fields like AI and high-end manufacturing. Rival nations must make their markets indispensable, forcing capital to allocate to them based on industrial advantage rather than just low prices. This institutional innovation locks down global asset pricing power for the next decade. By extending its trading hours, Nasdaq has altered the underlying rules governing global capital flows, ensuring the world remains tethered to the American financial system.